going to dive deep into what's been happening in the real estate market this year. Let's welcome to the stage Rick Sharga, Executive Vice President at RealtyTrac.
So, just checking the mic. Good morning. No, that's not going to do. We haven't been together for 2 years. Last time I was with this group was September 11th, 2019. We're in person for the first time in 2 years. I want them to hear you in San Francisco. Good morning. Good morning. That's better. That's what a live audience sounds like, not a Zoom meeting, just in case you've forgotten. We are going to cover a ton of stuff. We have 39 minutes and 24 seconds, 23, 22. And we're going to cover about 3 hours of stuff in that period of time, so strap in. Happy to answer any questions afterwards. You can catch me for a while. We're going to talk about the U.S. economy, what's been going on there, the U.S. housing market, those two things being inextricably interrelated. We're going to talk very briefly about California, Florida, and Texas housing, partly because we don't have a lot of time, partly because you're all more experts on your local markets than I am. I'm not going to try and fool you that way. We're going to talk very, very briefly about the commercial real estate market, which has made a remarkable turnaround in the last couple of months. We're going to talk about forbearance and foreclosures, and then I'll give you some closing thoughts, and then probably run off the stage before you throw anything. Really nice to see all of you again that are familiar faces. Nice to see those of you that are new, as the voice of God mentioned a few minutes ago. And by the way, I don't know what everybody complains about with rappers. Did you hear him earlier? He's talking about puppy dogs. I think rap must be just a really friendly, nice kind of musical genre, and I don't know why it's got such bad press. Before we get into this, as he mentioned, my name is Rick Sharga. I'm an Executive Vice President at RealtyTrac. Just a quick 30 seconds on RealtyTrac for those of you who don't know about us. We publish the largest database of distressed properties in the country, properties in all 3 stages of foreclosures. We're used mostly by real estate investors and agents who work with investors who are looking for off-market and below-market properties. We also have agents use the website looking for listings for borrowers who are underwater or who are in financial distress and would be much better off listing their property and selling it rather than losing it to a foreclosure. So that's it about RealtyTrac. If you have any questions about that, happy to answer later, but just wanted to give you some context. And we do have property records for all 110 million residential properties, so I'm kind of neck deep in this data all the time. When we met 2 years ago, I probably told you something like this. The U.S. economy is hitting on all cylinders. We have a 3.5% unemployment rate, which is the lowest rate we've had in 50 years. Black and Hispanic workforces had the lowest unemployment rates in history. Women in the workforce numbers were the highest they'd ever been. Inflation was under control, below 2%. We were creating 200,000 jobs a year. The housing market had fully recovered from the Great Recession. Home sales and home prices were going up. And then I said something really stupid, because I said this at almost every event at that time. I said it would probably take a global catastrophe to derail the economy and the housing market. And you could almost hear somebody biting into a bat in Wuhan, China, when I said that. So I made a vow. I made a vow to never again tempt fate in a housing market outlook presentation. I had no idea I was that powerful. But what has happened in the U.S. economy since then? Well, if you take a look at the chart, you can see that we had the biggest single drop in the history of the gross domestic product, biggest single quarter-over-quarter drop, about 31%. The only good news there was it was expected, and it was actually expected to be worse. That was followed by a 33, almost 34% increase. Now, for those of you like me who are challenged by basic math, a 31% drop followed by a 33% increase does not get you back to where you were. But the subsequent quarters that we've seen have basically taken the economy almost back to fully where it was. Keep in mind the U.S. economy is based 70% on consumer spending. And so when the pandemic hit and everything got locked down, it turned out that consumers could only spend so much money on toilet paper, especially when the local grocery stores were out of it. So that's why we had that huge drop-off. Everything got closed up. The government put an unprecedented amount of activity into making that recession as brief as humanly possible. And so what we're looking at now is probably an annual GDP growth of about 7%, which will be one of the highest on record. So the economy is recovering, and it's recovering much more quickly than most industry experts had expected. I mentioned consumer spending is the big driver in the U.S. economy. Consumer spending and consumer confidence tend to go hand in hand. And you can see back when the pandemic was declared, consumer confidence fell off a cliff and consumer spending went right along with it. Consumer spending has outpaced consumer confidence over the subsequent quarters. So it's come back very strongly, and it's come back to a certain extent, despite the fact that consumer confidence has gone up and down depending on what's been going on with the coronavirus. Most recent consumer confidence numbers were horrible because we saw a huge spike in infections due to the Delta variant. So it's going to be a bumpy ride for a while when it comes to consumers. What's offset that a little bit from a spending perspective is the $7 trillion or so that the federal government has injected into the economy. There was the first stimulus package under the Trump administration. There have been a subsequent 2 stimulus packages passed by the Biden administration. We now have the infrastructure bill, which should give the economy some runway for the next couple of years. Keep in mind, infrastructure spending doesn't happen overnight. It takes a while to get those shovels into the ground to get projects started. So that'll give us some cover for a while. In case you're wondering, it's very, very likely that there will be some unintended consequences from all the government spending. One of them is inflation. I mentioned earlier that inflation was under control the last time we talked. Inflation is running at about 5% right now, roughly 2.5 times where we were a couple of years ago. The Federal Reserve and the administration both hope that's transitory. Transitory means try not to pay attention to this while we figure it out. That's the official government definition. Inflation could be a problem for our market in a few ways. One, wages have gone up 4% over the last year, but inflation is now running at 5%. So even though people are making more money, it's costing them more to buy the same stuff from a year ago. So if inflation keeps going up, people have less income to spend on housing. That's an issue. If inflation continues to go up, interest rates will go up. And interest rates are the one thing that has really kept housing affordable despite the price increases we've seen over the last couple of years. So there are a number of things that could impact housing if inflation continues to go up. Unemployment went up as the economy went down. We lost 22 million jobs virtually overnight. Again, unprecedented numbers in U.S. history. So we went from a 3.5% unemployment rate, best it had been in 50 years, to 15% virtually overnight. Almost unfathomable how that happened. What's been equally unfathomable is how quickly we recovered. If you go back to the Great Recession, around 2008, 2009, 2010, the unemployment rate peaked at about 11%. But it took all 8 years of the Obama administration and the first 2 years of the Trump administration, a full decade, 10 years, to recover all the jobs that were lost. The pace we're at right now, we will have recovered all 22 million lost jobs by next year. A 2-year swing. That's one of the things that makes this recession so much different than prior recessions. The other thing that makes this recession different, and one of the reasons that the housing market has not really just completely gone sideways, and I have to say sideways because we're in Napa Valley and the movie was up here. Obscure movie reference for all of you. So the reason it hasn't gone sideways is where the job losses were. So because of the shutdown, we had a significant drop-off in the service industries, retail, restaurants, travel, tourism, hospitality, entertainment. So any of you who live in markets that are really heavily dependent on those kind of industries have probably seen your recovery been a little slower than it's been in the rest of the country. But those markets tend to be populated by employees who are at the lower end of the wage scale. They tend to be younger employees. They tend to have less formal education. They tend to be making less money. They tend to be less experienced. They tend to be renters much more often than they tend to be homeowners. So when you hear people talk about a K-shaped recovery, it's because the people who weren't in those industries have actually recovered very, very nicely since the recession. Those service level industries are really the laggards. And in fact, when we talk about how rapidly the jobs have come back, And I'm showing you unemployment rates. The most recent unemployment numbers from last week were 340,000 claims. That's the lowest number we've had since before the pandemic. So unemployment now is down to about 5.4%. So down from 15% to 5.4% in about a year. Just remarkable. Would not be a surprise to me to see unemployment rates below 5% by next year. And by the way, 5%, historically speaking, isn't a bad unemployment rate. It's kind of what you'd normally expect. So we're getting back to normal. But in terms of the jobs that have come back, those service industry jobs have been lagging the rest of the economy pretty significantly. My wife and I are up here. We came over the weekend. We're celebrating our 28th anniversary. Thank you. Easy for me, shows a lot of patience on her part. But we spent part of our honeymoon in Napa Valley and decided to come back up here because I had the opportunity to be with all of you folks and visit some of the wineries that we visited 28 years ago. But I have to tell you, walking through downtown Yountville and St. Helena and Napa, you can see where the economy hasn't fully recovered. You can see just lots and lots of vacant storefronts where there used to be people working, where there used to be people spending money. So that's the part of the economy that's going to take the longest to come back. And we'll see what happens with retail. Retail had been one of the sectors that was struggling in the commercial market even before the pandemic. And the hotel industry is the other one that really got hammered during this recession. We'll talk a little bit more about that later. So what is all this doing to the housing market? Well, I hate doing numbers sometimes because as soon as I put something on a slide, the numbers change. So this morning, we had July existing home sales come out. And what I'm very happy to tell you is that July home sales were actually up over June and 1.5% above last year's July sales. So last May, I was on a webinar with a very well-known real estate industry analyst who sells his reports for thousands of dollars, and he very confidently predicted that 2020 home sales would be off by 40 or 50% compared to 2019. I won't tell you who he is. But at the time, it was a perfectly reasonable thing to speculate about because we started off 2020, the blue bars here, in a very strong manner. January, February, and the first 2 weeks of March were really, really strong before everything fell off a cliff when the pandemic hit. March was awful. April, May, and June, which typically would have been growth months, we saw year-over-year declines. And in March and April and May, we saw month-over-month declines. And so it wouldn't have been hard to imagine that if we lost the spring selling season, which you guys know is critical, that we wouldn't be able to make it up. But what happened was from June, July, August, September, October, November, December, numbers were just off the charts. We had a completely counter-cyclical year where that second half of the year was really strong. So here's my warning to you for the rest of the year and what you're going to see in Inman News and Housing Wire. You're going to see reports every month about how home sales are down year over year. Pretend you didn't read those headlines. Because what we're going to be competing with in September, October, November, and December are 2020 home sales that were an aberration. We never see sales growing that time of the year, but we did last year. So when we go back to a more normal cycle, which is kind of what we're in right now, you're going to see those year over year numbers go down. And that's okay, because they should be going down. They should be getting back to normal. Compare them to 2019. Email me. Send me a text, and I'll give you the real numbers from 2019 versus this year if you get concerned. And you shouldn't get concerned. You're doing $40 billion in sales. Congratulations to all of you. But I don't know where Guy is. I don't want him to get the wrong idea. I don't want you to lose your motivation. The residential real estate market is $1 trillion market, so you got a ways to go. You got a ways to go. Anyway, July numbers came out this morning. They came out at almost $6 million, or 6 million units in annualized sales. It would not be a huge surprise if we finished 2021 with 6 million existing homes being sold. We would be selling more, except we're doing this in the face of the lowest inventory we've seen on record. A good buddy of mine named Mike Simonson runs a company called Altos Research. Some of you may be familiar with that. He tracks sales and inventory numbers. And he was the first person this year to notice that inventory appeared to finally have bottomed out and was starting to come back up. So for the last couple of months, we've actually seen minor improvements in inventory. I want to emphasize the word minor there. We're running still at about 2.6 months of available supply. That means number of houses divided by how many sales are going on, that's how much supply we have. In a normal market, a market with equilibrium, we'd be at 6 months supply. Here in California, in most markets, we're at a month and a half supply. Texas and Florida, similarly very low numbers, particularly in the hotter markets. That obviously creates bidding wars, demand is outpacing supply, so we're not back yet. There have been published reports that we're off by about 6 million units. I think those are overblown. But my personal estimation is we're probably somewhere between 2.8 and 3.2 million units short on what's available. We're going to talk about new homes in a second, but don't forget the existing home market as one of the root causes for the weakness in inventory. Okay, 80 to 90% of sales in a given year are existing homes, not new homes. We haven't seen a lot of these homes being listed. Partly it's because people are staying in their houses longer. Boomers are actually aging in place instead of downsizing and moving out. One of the reasons they're not downsizing is because Junior and Sissy have returned from college, and the parents need the extra room for the Xbox or whatever else is going on. I do think, pro tip, take the Xbox outside. When Junior goes out for it, change the locks, problem solved. It's probably why I'm never going to be Parent of the Year. But we went from the Great Recession when millennials moved home. They started forming households. The pandemic hit. We actually had an all-time high in young adults living at home with their parents. They are starting to form households. That's part of what's driving the demand, is millennials forming those households. But people are not putting their homes on the market. Partly it was the pandemic. People didn't want strangers walking through their house while there was a coronavirus floating around. They didn't want to go to open houses themselves and catch something from somebody else. And now there's a psychology hangover that some of the research is talking to us about, which is that people would like to sell their house, but they're afraid to sell it because they're not sure there's anything for them to buy if they're successful selling their house. So it's going to take a while to work through that kind of consumer psychology. New home sales are slowing down a bit, and that's because of lack of inventory. We started off this year looking like we might sell 1 million new homes, and I believe we might be able to if there were 1 million new homes to sell. But if you look at the new home market, and this chart may be hard to figure out from where you are, but the blue area is homes under construction, the red area is homes that are completed. Look how few homes there are available that are completed from the builders. So they've been selling more and more units while they're under construction. They've been selling more and more units where the ground has barely been broken. And so they've been kind of dragging that demand forward because the pandemic caused a lot of people to stop being apartment renters and to start being homeowners. And they also moved out of urban areas into suburban areas and distant suburban areas and even rural areas. And guess where the builders have been building? So you see this movement partly for health reasons, partly because people can now work from home, so they're going to work wherever they want to work, partly because that young couple found out that it wasn't quite as much fun to be quarantined with a toddler in a 700 square foot apartment as they thought it was going to be. So they've started moving out. So you see a little bit of distortion in numbers in places like New York City and San Francisco, to a lesser extent in places like Seattle and LA, where you've seen this out-migration into suburban areas. And that's driven a lot of new home sales. But the builders have actually started slowing down their selling because they're having trouble getting enough labor to build the houses. They're having trouble getting enough supplies to build the houses. They're selling properties without appliances because the appliances are all on back order. So all the supply chain disruption caused by the pandemic is resulting in it being difficult for the builders to meet demand. Now the good news is housing start numbers are up around 1.2, 1.3 million. We need to be at those numbers for the next 3 or 4 years. to really put a dent in the supply and demand imbalance. And it looks like builders are moving in the right direction. Remember I talked about unintended consequences of pouring a lot of money into the economy? One of the unintended consequences is that lack of labor. So there are actually more jobs available today than there are people collecting unemployment. That almost never happens. But there's a disconnect in geography. The jobs are available where the workers aren't, and vice versa. There's a disconnect in skill set. A lot of people looking for work but don't have the right skills for jobs. And candidly, and I've heard this from hiring managers across the country, there's a disconnect in pay scales. So people are actually making more money because of the enhanced unemployment benefits by staying at home and collecting than they would make if they went back to work. So those enhanced benefits are set to expire next month. I suspect after that you'll see a lot of those jobs being filled, and you'll probably have a lot of people regret not taking that $1,000, $2,000 signing bonus to sign up at McDonald's, which is just amazing. But the builders have actually literally stopped or started to slow down their home sales because they can't meet their contractual obligations to have the homes ready in time. So that's an interesting trend to watch, very, very different than usual. Demand is still very strong. It is driven partly by low interest rates. This is an eye chart that I got from the Mortgage Bankers Association. For those of you in the back, good luck. But really the red line you're seeing there, which is what everybody's paying attention to, is mortgage applications last year for purchase loans. And again, you can see that had a huge dip in the spring and really unusually high numbers for the rest of the year. So we're really comparing this year to 2019, and it's running pretty similar. It had a very strong start and has slowed down since then, but we're seeing the numbers kind of come back to earth, but still not weak demand by any stretch of the imagination. Demographics suggest we are going to continue to see high demand. So if you're wondering what happens next year and the year after, the largest group of millennials, who are the largest group in generational terms in the history of the United States, are rapidly approaching prime home buying age. So they are starting to form households. I said they're moving out of home with mom and dad. They decided it's not as much fun to have 3 roommates in an apartment as they thought it was, so maybe it's time to buy a house, and this is driving an awful lot of the demand. So the numbers don't lie. Lots and lots of people forming households. There's not a lot to buy, so it's actually driving rental rates up. Rental rates are rising at historically high levels. Vacancy rates are the lowest they've ever been in the rental market. So not a lot of places to rent, not a lot of places to buy, and our research suggests that most people overwhelmingly prefer to live indoors. So this creates some of that supply and demand imbalance. Supply and demand imbalance equal record home prices. You're certainly seeing that in your markets. When I get to the California numbers in a couple seconds, you'll see that California's median price in June was $800,000. And what that means in simple terms is that neither of my kids will ever be able to afford a house in California. It's just, and by the way, it's one of the reasons you're seeing less first-time homebuyer activity. According to the NAR numbers this morning, about 30% of sales are first-time home buyers. In a normal market, that's usually between 35 and 40%. So there's nothing for those folks to buy. But prices are up, depending on whose numbers you believe, anywhere from 16, 17, 20% on a year-over-year basis. Before you ask the question, no, we do not believe we're in a housing bubble yet. But if we keep seeing prices go up like they did, they're announced this morning 17.8% year over year, a bubble is definitely in our future. But one of the things that has kept us in non-bubble territory is the fact that we have record levels of homeowner equity, $23 trillion in homeowner equity. So a lot of the people buying these really expensive houses have tapped into the equity they've generated in their also expensive houses, and they're making big down payments on these properties. And that's making them affordable. That combined with the historically low interest rates. Up until about 6 months ago, if you looked at the average mortgage payment year over year, 49 of the 50 states, you saw that the mortgage payments had gone down, even though the home prices had gone up. Anybody care to venture a guess which the one state was where things were more expensive year over year? California, yes, you get the prize. So we were the first state to break that model. But we're seeing people with equity buy houses using that equity so they can afford them, and they can afford them again because of the low interest rates. When we had the last bubble, it was people that couldn't afford the houses they were living in who were buying overpriced houses with adjustable rate loans that turned out to be ticking time bombs. So very, very different market dynamics. But realistically, you can't have wages go up 4% a year and home prices go up 18% a year for long before you do get into bubble territory. I'm not going to spend a lot of time, as I said, on the state markets, only again, because you guys are really the local market experts. But if you look at numbers from California Association of Realtors, Texas Association, along with Texas A&M, and Florida Association of Realtors, all of the states are kind of a microcosm of what's going on across the country. And in some cases, they're actually doing better than other parts of the country. California in June, 34% increase in sales on a year-over-year basis. Prices 30.1 or almost 31% up. And this is the other thing that's interesting. California median days on market, 8 days. 8 days. Nationally right now it's 14 days. Now I know you guys are cheating. You're not fooling anybody. So I know you have these listings. You don't put them on the MLS until you have the contract signed, because I see it go on the MLS and it's already pending. So I know what you're doing. But it's okay because you're still selling the property and your client's doing okay. But this is what's going on in California, red hot market. And this is important across the country when we're talking about price increases. Keep in mind part of that's driven by product mix. So we're seeing more activity at the high end of the market than is normal. That's partly because there's nothing available for sale at the low end of the market. Nothing available for sale. Before you blame the investors, it's not the investors. Investors do not make their money by buying overpriced properties. So despite what you read in the Wall Street Journal about investors, Wall Street gobbling up Main Street, when you look at the 50 people lined up for the open house, I promise you none of those are from Blackstone or BlackRock or any big institutional investment firm. And in fact, if you look at who owns investment properties, 90% of single-family rental properties are owned by mom and pop investors who own somewhere between 1 and 5, 1 and 10 units. That's who you're competing with. And in fact, those investors, in the research we do an investor sentiment survey, those investors say they have more competition from traditional home buyers than they do from the big institutions. So that's who's gobbling up these properties. Texas, 19% price increase on a year-over-year basis. 50% of sales are between $200,000 and $400,000. So you're seeing a lot of activity in those areas. Active listings were down 42%. Again, this gets to inventory available. Days on market, 32. So Texas, you're taking longer. I don't know what that's all about. Get on your horses and get moving. But only 1.5 months of supply, and closed sales are up almost 25% year over year. Florida, sales are up 43%, prices are up 24%. Probably not surprising any of you with any of those numbers, but it's, when you're looking at what was already a good year in 2020 and you're seeing a 43% increase in sales, it's just mind-boggling. It really is mind-boggling. So people are looking to buy properties. Quickly on the side, on commercial real estate, we'd have had a very different conversation a month ago. I would have told you that the market was still in recovery. It was hurting. Prices were down. Sales volume was down. And literally in the last month, 45 days, we've seen a complete turnaround in the commercial real estate market. Beginning of the year, first quarter, we looked at our RealtyTrac database and saw that 10 times more commercial loans of $5 million or more were in foreclosure than we normally see. Now, those numbers, just to put them in context, you don't see a lot of commercial foreclosures for big loans. So we might have gotten 5 to 10 a month, but the first quarter we were seeing 50 to 100 a month. So it was a big shift in terms of just scale. Those numbers have dropped back down. So we're actually seeing year-over-year increases in the volume of sales in every category, except development sites, because people aren't building a lot of new stuff. This is national. And we saw, again, the overall number of transactions up. Look at the hotel number there. 253% increase year over year in the sale of hotel properties. And I don't know how many of you do commercial in addition to residential, but one of the things that I had talked about earlier this year, if you've seen any of the online work, is that the hotel industry was going to be one of the hardest hit. Because what I've learned over the years is that a lot of limited service hotels, think your Marriott Fairfield Inns and your Hilton Garden Inns, are owned by small individual investors. And they simply don't have the financial wherewithal to go through 2-3 years with 70% of the rooms being vacant. But instead of foreclosing on those, what they've done is they've sold them off probably at slight discount prices. So we've seen just an enormous amount of purchase activity from new investors coming in and buying those hotel properties. Property prices are up almost 1%. And again, if we'd had this conversation as little as a month ago, I would have been telling you that the prices were off about 5 or 6% nationally. So a huge uptick in the last few months. And delinquencies on loans have come down pretty significantly in every category except retail and lodging. So again, the commercial market is doing much better. If you're looking for if you're working with investors who are looking for investment opportunities, I would still say to keep your eye open for small dollar commercial properties in your local areas, particularly in the retail, hospitality, and small office segment. Because there's a lot of disruption in those three segments. Drive by that strip center, and if you see more than half of the stores are vacant, that owner's probably looking for a nice exit. And you don't see quite as many foreclosures in the commercial market as you do in the residential market because they tend to do workouts more often than they foreclose. Speaking of foreclosures, foreclosure activity has virtually stopped. So we entered the pandemic running at about half the normal level of foreclosure activity. In a given year, normally, about 1% of loans are in foreclosure. Prior to the pandemic, it was about 0.5%. We also had lower than average delinquency rates, despite the fact that we had an unprecedented number of natural disasters, which inflated those numbers a little bit. But since the government put a foreclosure moratorium in place back in February of 2020, there's virtually nothing going into foreclosure except some commercial properties and except maybe vacant and abandoned properties in some markets. Delinquencies, on the other hand, tend to follow unemployment rates. So we saw that huge spike in unemployment. We saw mortgage delinquencies spike up as well. And they've come back down. So where we were at about 13% delinquency rates, we're down to about, this is a little bit dated information, we're actually down to about 5.9, 5.8% delinquency rates. Normal delinquency rates are about 4%. So we're still a little bit above normal, but getting much better. And delinquencies have actually fallen for 9 consecutive months. So the headlines all read serious delinquency rates still at very high levels. And that's true, but it's not as true as it was previously. And again, everybody who's reporting these, Fannie Mae, Freddie Mac, Ginnie, the Federal Reserve, everybody else is reporting the same thing. These are Mortgage Banker Association numbers, but 9 consecutive months where delinquency rates have gotten better. In fact, new delinquencies, 30-day delinquencies, are the lowest they've been since the MBA started tracking these numbers in 1979. So I would submit to you, if the economy was struggling, if homeowners were struggling, these numbers would be a lot worse, not a lot better. And the biggest chunk of loans that are in delinquency are in the government's CARES Act mortgage forbearance program, where the government said, if your income was affected by COVID, talk to your mortgage company, tell them your income was impacted by COVID, and you don't have to make mortgage payments for 6 months. And then if you need it, you get another 6 months. And then it was extended for another 6 months. So if you're one of the first people in forbearance in March of 2020, your expiration is finally next month. So you've gotten through 18 months without having to pay your mortgage. What happens at the end of that? Do you owe all 18 months and you're going to be thrown out on the street? Again, don't believe what you read in the press. So the payments have not been forgiven, but they've been deferred. So what will happen with a government-backed loan is all of that past due money gets tacked onto the very end of your loan term. So when you get to year 30, you have a balloon payment due. But guess what? Do home prices go up or down over 30 years? Yeah. So if you're gonna have to refinance your way out of that, great. But you can pay off those debts when you refinance your loan, when you sell your house, or when you get to the end of your loan term. And in fact, we've gone through a really remarkable progression with this program. Probably the best example I've ever seen in the 20 years I've been in the real estate and mortgage industry, of the government and the industry working together. And we have literally prevented millions of unnecessary foreclosures. And my definition of unnecessary foreclosure is foreclosing on somebody who wouldn't have been in financial trouble except for COVID. And all told, this program peaked with about 4.4 million people in forbearance right after the program started. This is what it looked like then. And All told, about 8 million people, a little over 8 million people have entered the program and either are still there or have exited. We're down to 1.6 million people in the program as of the end of last week. About half of those are scheduled to roll out between now and the end of the year. The other half will very gradually roll out over the balance of 2022. This group, this 1.4 million, is why the seriously delinquent numbers in the mortgages look as high as they are. These people are not being reported to the credit bureaus as delinquent, but their loans in the industry are counted as delinquent because no payment has been made. So they can miss their payments for 18 months, and after 18 months, day one, if they enter into agreement with their servicer on repayment plans, they're no longer delinquent. That's not normally how delinquency works. Normally, if you haven't made a payment a year and a half, you're in foreclosure or you've moved on. So again, this is all behaving very differently. And again, you can see the requests to enter the program peaked the end of March in 2020 and have gone down ever since. So I would submit again, if things were getting worse, we would have seen spikes at the end of every other month when next month's mortgage payments are due, but we haven't. Most of the borrowers still in forbearance are there either on extension. Remember, I said it was initial 6 months, and another 6 months, and another 6 months. So it's how the program was supposed to work. I'd be more concerned if at this point we had a lot of new people in the program. So anybody who's worrying about a flood of foreclosures hitting the market when these government programs expire, stop worrying. It's not going to happen. In fact, what we've seen is that 85% of the people who have exited forbearance, remember I said 8 million people have been through since the beginning, so 6.5 million have already exited, and delinquency rates have gone down. So what does that tell you? It tells you these people have exited successfully. A quarter of them have never missed a mortgage payment. So they haven't had to make a mortgage payment, but they've kept making their monthly mortgage payment anyway. So they were only in the forbearance program to hedge their bets, just in case something bad did happen to them financially. Another 20% have gone into a deferral program, a repayment program like we talked about. There's a growing number that will be in loan modification programs. So the lender will be able to extend the terms of the loan. Ginnie Mae's now approved a 40-year term for a loan if you need more time to get that monthly payment down. Most of these borrowers are not in loans with interest rates as low as they are today, so they can reduce interest rates, and they can also defer principal balance payments, anything they need to do. And in fact, the CFPB, the Consumer Finance Protection Bureau, has new rules in place that are related to COVID that forbids a lender from having a loan modification where the payment is higher than it was prior to the modification. So everything really is geared up toward helping these borrowers. 15% roughly leave without a plan in place. Most of those wind up with a plan in place shortly after they leave. But those are probably the most vulnerable. If you're really looking at, and I'm hoping you're not getting that no signal. Okay, there you go. If we're looking at areas of vulnerability, and this does actually impact some of you, because these 3 states are disproportionately affected, it's the FHA portfolio. And the FHA borrower typically has less equity, less income, less cash reserves, and higher debts. So if they get into trouble, it's often a little harder for them to get out of trouble. And markets where you have a high percentage of FHA borrowers and a high percent are delinquent are markets that could be problems. There's a few in Florida, Orlando and Tampa. There are a few in Texas, Houston, Dallas, and San Antonio. There's a couple in California, most notably Riverside, San Bernardino, where there are a high percentage of FHA borrowers and high delinquency rates. So while we won't see foreclosures or even FHA foreclosures have a big effect nationally, there could be an impact on some local markets. But as I said, foreclosure activity is not going to be rising dramatically. This is not a repeat of 2008. Loan quality was excellent going into the pandemic. The recovery is outpacing expectations. The government industry intervention has been just remarkable. And this is where you come in as agents. This is what I was talking about RealtyTrac. 75% of homeowners have more than 20% equity. 91% of borrowers in forbearance have more than 10% equity. There is literally nobody who should lose a house to foreclosure if they have equity. But if a borrower finds themselves in foreclosure, they very often go into denial and go into hiding. And agents like you who know what you're doing, and you guys, I'm not saying this just because I'm here, you really are the best of the best. Agents like you who know what you're doing can provide a huge service. and prevent these people from having to go through a foreclosure by helping them tap into that equity, list their home for sale, walk away with money in their pocket, and get a fresh start. Much, much better alternative than going through foreclosure. And an option, by the way, that homeowners did not have during the Great Recession, when 33% of properties were underwater on their mortgages. So that record equity level today is a big, big difference. And because of the supply and demand imbalance, there's a very ready market for people. So I'm curious if I can get through my closing thoughts in 38 seconds. Can you give me another half an hour? No, it's, so strong market, housing market absolutely will continue into 2022. There's just, barring a global catastrophe. Sorry. Hey, even the global catastrophe didn't derail housing, right? We had a strong year. Home prices will continue to rise, but more slowly. We really are starting to hit what I call an affordability wall, despite the low interest rates, where the home prices are just rising much more rapidly than wages, and that can't go on forever. But as builders ramp up, we'll start to see that slow down. We're going to see an increase in default activity, but not at the levels we saw last time. The FHA portfolio is probably the most vulnerable to potential default. Segments of the commercial market are vulnerable as well. And I didn't mention this, but I mentioned earlier that the single-family rentals are mostly owned by mom-and-pop investors. We are now approaching 20 months of an eviction ban, which makes it illegal for landlords to evict a tenant for non-payment. These are small investors. In some cases, they're retirees whose entire income is coming from their rental collections. They're individual investors paying their mortgages with the rent they collect, and those properties don't have the same mortgage protections that owner-occupants do. So we are seeing markets where we believe there's a high degree of risk that these small landlords are going to be in danger of foreclosure or bankruptcy, or at the very least, will have to sell off their properties at a loss. So with that, I want to congratulate you on your success. I want to thank Guy, Hillary, and Ed for inviting me back again. Hope to do this again next year with an even bigger crowd, and hope you'll all really enjoy the rest of this wonderful Side REunite event. Thank you for your attention. Take care.